Welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Rsi Boundary Rejection. This is a mean reversion reversal approach that fades failed breakouts at rolling support and resistance with a momentum filter built from the relative strength index. Over the next few minutes, we'll unpack how the strategy defines its levels, how it spots a failed break, how it confirms that signal with the RSI, and how it manages its stop and its target. Everything here is for educational purposes only, and none of it is financial advice. So let's get into it. Let's start with the big picture. RSI boundary rejection is a counter-trend, mean reversion strategy. Instead of chasing breakouts, it does the opposite. It waits for a breakout attempt to fail, and then it fades that failed move back into the range. The whole idea rests on a combination of just two ingredients: price action structure and momentum from the relative strength index. Here's the thinking behind it. In liquid markets, price will often poke just beyond an obvious level, a recent swing high or a recent swing low, only to snap back inside the range because there was no real continuation behind the move. That probe and reclaim behavior is a classic reversal tell. On its own, though, a single poke through a level is noisy, because plenty of pokes are actually the first leg of a genuine breakout. So this strategy adds a second condition. It only fades the failed break when momentum is already stretched in the same direction. To do that, the strategy continuously marks structure. Over a window of recently closed bars, it records the highest high as resistance and the lowest low as support. Those levels update themselves automatically on whatever symbol and time frame you load, so there's no fixed pip or point math involved. The signal bar must pierce one of those levels by a meaningful fraction of the average true range, and then close back inside the range. The relative strength index then has to agree, sitting in oversold territory for a potential long, or overbought territory for a potential short. In terms of who this is designed for, it leans toward a swing and mean reversion style of trader, someone comfortable waiting for a clean setup rather than trading constantly. The default playground is a mean reverting currency major or a metal. Think the euro against the US dollar, the Australian dollar against the US dollar, or gold, on the 15-minute up to the 1-hour chart. As always, remember that trading carries real risk, and losses are a normal part of the process. Now let's walk through the exact logic, step by step. The strategy works on closed bars only, checking its conditions once each time a new bar completes. First, it builds the level. Over the last 20 closed bars before the signal bar, set by the Lookback parameter, it finds the highest high and calls that resistance, and the lowest low and calls that support. These are real, self-updating structure on whatever chart you're running. Second comes the sweep, the part that defines a failed break. For a long setup, the strategy detects when the signal bar's low drops below support by at least a fraction of the average true range, and yet that same bar closes back above support. That fraction is controlled by MinPierceAtr, defaulting to 0.05 of an ATR, which screens out a tiny rounding touch and demands a genuine probe. The close back inside is the rejection. The breakdown attempt failed on its own bar. The short setup is the exact mirror. The signal bar's high pushes above resistance by that same buffer, then closes back below it. Third is the exhaustion filter, and this is the RSI. For a long, the signal bar's relative strength index must already be at or below the oversold level, which defaults to 35. For a short, it must be at or above the overbought level, defaulting to 65. The reasoning is a two-sided agreement. Structure rejected the move, and momentum says the move is spent. Either signal alone is ignored. Requiring both together is the core of the approach. Now the risk side, which is entirely ATR-based, so it scales itself to any symbol or time frame. On a long, the stop is placed below the signal bar's low, with an extra buffer of 1.2 times the ATR by default, set by ATR/SL multiple. The logic is simple. If price trades back through the very low that was supposed to reject it, the reversal idea is invalidated. The take profit is then placed at a fixed multiple of that stop distance, governed by the reward ratio, which defaults to 1.8. The short side mirrors this exactly, with the stop above the signal bar's high. There's also a spread filter that skips the trade if the spread is wider than max spread points, and one position at a time per magic number. Let's read through the MQL5 on screen, as if we were sitting in MetaEditor. At the top are the inputs you can tune. Lookback sets how many closed bars define the swing high and low. RSI period is the smoothing for the relative strength index. Oversold and overbought are the momentum thresholds, defaulting to 35 and 65. MinPierceAtr sets how far price must poke beyond a level. ATR/SL multiple sets the stop buffer, and RewardRatio sets the target as a multiple of the stop. Now look at the long block. The Boolean called swept support is true when the signal bar's low is below support minus the Pierce buffer, and the signal bar's close is back above support. That's the failed breakdown in one line. The if statement then adds the condition that our SI is at or below oversold. When both are true, entry is taken at the ask, the stop loss is set just below the signal bar's low minus the AT or buffer, risk is the distance from entry to stop, and the take profit is entry plus reward ratio times that risk. Then trade.by places the order. The short block is the exact mirror. Swept resistance is true when the signal bar's high is above resistance plus the buffer, and the close is back below resistance. With our SI at or above overbought, the strategy sells at the bid, sets the stop just above the signal bar's high, and places the target the same reward to risk distance below entry through trade.sell. Let's bring it all together on this illustration. On the price chart, you can see two dashed horizontal lines. The green line is support at 1.0830, the lowest low over the recent window. The red line is resistance at 1.0900, the highest high. Below the candles is the relative strength index, with the oversold band at 35 and the overbought band at 65. Watch the first few candles. Price is drifting down inside the range, easing toward support. And notice how the RSI is sliding lower with it, heading toward that oversold band. Then we reach the fourth candle, and this is the long signal bar. Its lower wick stabs below support at 1.0830, far enough to count as a real probe, not a rounding touch. But by the time the bar closes, price has been pushed back up above support. That is the failed breakdown. At the very same moment, look at the RSI. It has dipped down into the oversold band, at or below 35. Structure rejected the move, and momentum says the down leg is exhausted. Both conditions agree, so on the next bar the strategy places the buy entry, shown by the buy marker. Now follow the risk plan. The stop loss is tucked just below that swept wick, below the candle's low, with an extra average true range buffer beneath it. The reasoning is clean. If price slides back through the low that was supposed to reject it, the reversal idea is wrong, and the trade is closed for a controlled loss. The take profit, meanwhile, is set at 1.8 times that stop distance. As the next candles print, price climbs back up through the range, and by the sixth candle it reaches the take profit target, marked above. The long idea has played out. Now the chart flips to the mirror image. Price keeps pushing higher, climbing toward resistance, and the RSI rises with it, drifting up toward the overbought band. On the ninth candle, we get the short signal bar. Its upper wick spikes above resistance at 1.0900, a clear probe beyond the level, but the bar closes back below resistance. That is the failed breakout. And right on cue, the RSI is pushed up into the overbought band, at or above 65. Once again, both halves agree, structure rejected the push higher, and momentum is stretched. So the strategy opens the sell entry, shown by the sell marker. The exit logic is the exact mirror of the long. The stop loss sits just above the swept high, with the average true range buffer above it, because a move back through that high would invalidate the short. The take profit is placed the same 1.8 reward to risk distance below the entry. Over the following candles, price rolls back down into the range, and by the 11th candle it reaches the lower take profit target. That completes the short. Notice the symmetry through the whole sequence. A failed break at a level, a close back inside, an RSI extreme confirming it, and a stop anchored to the wick that was supposed to do the rejecting. That is the entire idea, expressed twice. So that's RSI boundary rejection from top to bottom. We covered how it marks rolling support and resistance, how it detects a failed breakout or breakdown when a bar pierces a level and then closes back inside, how the relative strength index has to confirm the move is stretched, and how the average true range anchors both the stop just beyond the swept wick and the reward-to-risk target. Remember, this video is educational content only, and it is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses are part of the process, so always do your own research and test thoroughly. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and drop your questions in the comments. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.